This chapter looks at the principles of relevant costing. When we make decisions, we only need to be thinking about costs and revenues that are going to be affected by the decision that we're actually making. We call these relevant costs. And later we're going to be applying them to some specific decisions, but for now we're just going to think about the characteristics of what we mean by a relevant cost. First of all, relevant costs must be costs that are going to actually occur in the future. So if they've already happened, there's nothing we can do about it. Our decision's not going to affect it in any way. They also need to be cash flows. So in other words, they need to go in or out of the bank account. So we'll be looking at some examples of some costs that are not cash flows shortly. They also need to be incremental, which means that they must go up or down as a result of the decision that we're actually making. Relevant costs also might be opportunity costs. Now, opportunity costs can be defined in a number of different ways. So one way of thinking about an opportunity cost is a benefit sacrifice because we decide to do one thing in preference to an alternative. Sometimes we tend to think about this in terms of a benefit foregone from a course of action that would have been the best course of action as an alternative to the one that we're going to take. Quite often in questions, the way that this will manifest itself is by looking at lost contribution. So for an example, let's just say that we had some scarce resources, maybe some labour, and we had to decide whether we were going to use our labour to make one product in preference to another. The lost contribution from the product that we don't make is what we call the opportunity cost of making that decision. And finally, we've got avoidable costs. Now, an avoidable cost is often associated with what we call a shutdown decision. And a shutdown decision is often in relation to product lines. So when we decide to maybe discontinue a particular product, or maybe even more than that, maybe a whole division or a section of our company. So what we'll be looking for then are costs that are going to be avoided if we actually don't make the product or we don't actually continue operating that division. Let's look at non-relevant costs and revenues next. Now, non-relevant costs are still going to be in questions that you see, but they're there so that you can demonstrate that you know how to treat them, which is for the most part that you're going to ignore them. Now, the first of these refers to what we call sunk costs. Before we mentioned that costs, in order to be relevant, had to be costs that were going to occur in the future, and sunk costs are costs that have occurred already in the past. So they're not going to change our decision going forward, and therefore we can treat them by just ignoring them correctly. Now, committed costs are very similar to sunk costs, and the only difference between a sunk cost and a committed cost is the timing of the payment of it. A sunk cost will have actually been paid, whereas a committed cost hasn't yet been paid, even though you are committed to pay it at some time in the future. So examples of these might be, for example, materials that you've already agreed to buy under a long-term contract. Sometimes there's a clue in the question about committed costs because they make reference to maybe a penalty what will have to be paid if you actually default on the long-term contract. We've also got notional costs. Now, notional costs are non-cash items. The most common of these that you're going to see in your questions is depreciation. Depreciation is not a cash flow, and therefore we need to ignore it. And then finally, we've got fixed costs. Now, fixed costs are important because it really depends on the wording. There's certain words here that you can look out for in the question that are going to give you a clue as to whether the fixed cost is going to be relevant or not relevant. If you see words such as allocated or apportioned, then that cost is not relevant, because all it means is that the cost has actually been shared out. For example, it might be some head office costs that have been shared out across a number of cost centres, and the head office cost has not changed as a result of the decision that's being made. So it's not incremental, and therefore we're going to ignore it in our relevant costing. However, we do have other costs that are fixed that might be specific to a decision. So, for example, our decision that we're making might require us to actually rent another warehouse and incur some more rental costs. So that would be a relevant cost. So it's important here to think about whether or not the fixed cost is going to change as a result of a decision, or whether or not it's going to stay the same. Let's explore the idea of non-relevant costs in a bit more detail. Lecture example 1. APLC is preparing a tender for a new contract to build a bridge. The contracts manager has spent 40 hours already researching the contract and preparing the tender, and he's paid a fixed annual salary of $96,000 a year for working 48 weeks of the year, 40 hours each week. How much should we include as the relevant cost of building the bridge for the contract manager's time? Now, the correct answer to this is actually 0. And there are 2 reasons why it's 0. The first reason is because the cost is a sunk cost. He's already spent the time and the cost has already been incurred. The 40 hours has occurred in the past. The second reason why this is not relevant is because the salary is not an incremental fixed cost. It's actually not going to change as a result of this contract at all, and therefore, with it not being incremental or specific, it means it's non-relevant. Let's look at some specific examples of relevant costs. We're going to start with the relevant cost of materials, and to think about this, we're going to think about a small example. Let's just say that I run a factory. In my factory I make raspberry jam and I sell it to small shops. Now, I've just been approached by a major supermarket to make some batches of lemon curd for them, and I want to consider what the relevant cost of this is going to be. In other words, I want to think about what is the effect going to be on my bank account. So I need to start thinking about what ingredients I'm going to need for the lemon curd. And the first ingredient, which is probably an obvious one, is going to be lemons. Now, I don't actually use lemons in making my raspberry jam, and I currently therefore don't have any in my inventory in my stock room. So I'm going to have to go out and I'm going to have to buy some lemons, and therefore the price that I'm going to pay is actually going to be the current replacement cost. In other words, how much I have to pay down the market for them. That's going to be the effect on my bank account. Now, I've also got some other ingredients that I have got in inventory because I use them in my raspberry jam. The first of that is going to be sugar. Now, sugar is in continual use. I use it all the time in my jam making, and therefore if I take it from my inventory, then I'm going to have to replace it because I use it. Now, that means that when I go and buy that sugar, the price that I pay to replace it is going to be the relevant cost. Again, that's going to be the effect on my bank account. So the relevant cost of anything that's going to have to be replaced because it's in continual use is going to be the current replacement cost. Now, I've also got some preservatives. Now, I've gone organic in my factory and I don't use preservatives any longer, so I've got no other use for those, but I do need to use them in the lemon curd. Now, that means that if I take the preservatives that I've got from my inventory, I'm not going to have to replace them. So the relevant cost or the effect on my bank account, you could say, might be nothing at all, because I don't actually have to incur any cost to use those preservatives up in my lemon curd. But let's just say that there's a factory down the road who hasn't yet gone organic like I have, and they've offered to buy those preservatives off me for a certain sum of money. Now, if I use them, then I'm not going to be able to sell them to them, and that means that the loss of that resale value is therefore going to be the relevant cost. Finally, what happens if there's some scarce resources? So let's just say, for example, that there is a global crisis and sugar becomes a scarce resource. So if I actually use the sugar that I've got, I can't just go down the shops and buy some more. I can't replace it. Now, this is where we start to bring in the idea of an opportunity cost. Remember that an opportunity cost was a benefit foregone because we do one thing rather than another. In this example, it means that I can't make some raspberry jam because I'm going to make some lemon curd. Now, if we just have a look at this little cost card, then what we can see is that the raspberry jam actually sells for £5. And I've put some constituent parts, some sugar, some raspberries and some labour costs in there. And you can see that each pot of raspberry jam is actually making us £1 contribution. And therefore that would actually be the relevant cost of actually using that scarce resource of using the sugar. Because I'm going to make some lemon curd with it, it means that I'm not going to be able to make raspberry jam, and therefore I'm not going to get that £1 contribution. Lecture example 2 is about the relevant cost of materials. Let's have a look at the scenario. XPLC intends to print a catalogue for a one-off special promotion. The catalogue requires 120 boxes of a particular type of paper that's not regularly used by XPLC, although a limited amount remains in their inventory from a similar job. The cost when XPLC bought the paper 2 years ago was $17 a box, and there are 50 boxes in inventory. The boxes could be sold for $14 each, or could be purchased in the market for $22 each. What we've got to do is we've got to calculate the relevant cost of paper to be used in printing the catalogue. So let's break this down. We need 120 boxes in total. And we're told in the scenario that we've got some that's in inventory, and that is a total of 50 boxes. Now that means therefore that there must be 70 that we have to buy. So let's start with those 70. If we've got to buy them, then we have to pay the current replacement cost for those boxes. So in the scenario we're told that that is $22 a box. So 70 boxes, $22 a box will give us 1540. So what about the other 50, the 50 that are in inventory at the moment? Well, there's a big clue in this question, and it says that the paper is not regularly used by XPLC. Now you'll see a term like that in quite a lot of relevant costing questions. And what we know therefore is that we're looking for a resale value. So are we told a resale value here? Yes, we are. We're told that it could be sold for $14 each, and therefore $14 times 50 will give us a total of $700. So the total relevant cost is the sum of 700 and 1540, which is $2240 relevant cost. Section 3, the relevant cost of labour and variable overheads. Let's go back to my example with the raspberry jam and the lemon curd. Now I'm in a position where I need to find out what the relevant cost of my labour is going to be, and I need to think about my current labour force. Now I'm going to consider two different scenarios. The first scenario is that I've got some spare capacity within my factory at the moment. Not everybody is working flat out making raspberry jam, and I've got the potential to give them some more work to do. So they can actually make some lemon curd within their current capacity. I don't actually have to pay them anymore for the additional work that they're going to do. And therefore, the relevant cost, remember that the relevant cost is the effect on the bank account, is actually going to be 0. However, there is another scenario that we need to consider, and this one is a little bit more complex. What happens if we are actually working to full capacity at the moment? everybody is making raspberry jam and we haven't got any capacity to undertake any additional work. Now, within this scenario, there are also two scenarios that may actually occur as well. So let's take the first one, and this is where we can actually hire more staff. Now, in an exam question, this may actually be given to you in a number of different ways. You might actually get a choice between hiring some agency workers, in which you'll be given their rate of pay, or paying overtime to the current staff that are there. Now, clearly, I'm going to want to take the lower of those two options. So whatever the lower of those two options actually turns out to be, that's going to be the relevant cost in scenario A. However, what happens if I can't hire any more staff? Let's just take the situation where maybe I've got a self-imposed overtime ban. And therefore, in order to make lemon curd, some staff are actually going to have to stop making raspberry jam. Now let's just remind ourselves of the cost card for making raspberry jam. If you remember, we had a £1 contribution and the cost card comprised of materials of £2.50, that was the sugar and the raspberries, and labour of £1.50 for each jar of raspberry jam. Now, assuming that the same amount of labour is required for both, what's going to be the effect on my bank account if I stop making raspberry jam and I move my labour force into making lemon curd? Well, the first thing that's going to happen is I'm going to have some lost revenue. And the lost revenue is going to be £5 for each jar that I don't sell of my raspberry jam. However, I am actually going to save some materials costs because I'm not going to need to incur those if I'm not going to make a pot of raspberry jam, and that comes to £2.50. So therefore, I'm actually going to have a £2.50 reduction in my bank account. Now, this is actually equal to the variable cost of my labour, which is £1.50, and my lost contribution from my raspberry jam of £1, making a total of £2.50. Now, the important thing to realise is that in the exam, then often you're actually required to do it this way rather than the first way, because you're often given only the lost contribution and the variable cost rather than details about the revenue that will actually be lost and the materials saved. So just to summarise then, in a situation where you cannot hire more staff and you've got scarce resources in terms of labour, then the relevant cost is the variable cost of that labour plus any lost contribution that you might actually suffer because of having to move them from one thing to another. Lecture example 3 is about the relevant cost of labour. Let's have a look at the scenario. APLC is deciding whether to undertake a new contract. Now, for the contract, they need 15 hours of labour, and at the moment, their labour is currently working at full capacity, producing another product X. We've been given the cost card for product X. We can see that it makes a contribution of $25 a unit. We've got to work out what the cost is of using 15 hours of labour for the new contract. So let's just recap what happens in a situation where we do have the current labour force working at full capacity. Remember that sometimes it's possible to hire more staff, but in this lecture example, there's no mention of any agency staff or indeed any overtime that's available to be worked. So what we need to assume is that we're going to have to transfer the labour from working on product X to working on the new contract, which means that we're in this situation here where we cannot hire more staff, and therefore the relevant cost that we need to work out is going to be a total of the variable cost of the labour and also the lost contribution, in this case from not producing product X. So let's start with the easy bit first, which is the variable cost of labour. For this, we need to know how many hours, which we know is 15, and we also need to know what the variable hourly rate is. Now, looking at our cost card, we can see quite clearly that the hourly rate for direct labour is $6 an hour, and therefore 15 multiplied by 6 gives us a total of $90. Okay, so let's turn our attention to the lost contribution from not making units of X. Now, there's a couple of different ways that we can go at this. First of all, let's think about whole units of X and think about how many whole units of X we're not going to be able to produce because we need 15 hours worth of labour from the labour force that are currently making X at the moment. Now, it tells us in the cost card that it actually takes 5 hours in order to make 1 unit of X. And that means that in 15 hours, we're not going to be able to make 3 units of X. Now, each unit of X is making contribution of $25. And therefore, the total loss contribution is going to be 25 multiplied by 3, which is going to be a total of $75. Now, another way you might like to think about this is trying to think about the amount of contribution per hour. If a total unit of X is making $25 and it takes 5 hours to make 1 unit, then 1 hour is actually generating 25 divided by 5, which is $5. So the lost contribution from product X is going to be $5 an hour. Now, because we need 15 hours, therefore 5 times 15 gets us back to the same total as before, which is 75. So it really doesn't matter which way you do it, you're going to get the same answer. Just think what's easier for you to understand. So all that's left for us to do is to actually add together the two parts of this answer, which is 90 and 75. And that gives us a total relevant cost of $165. Now, when we were looking at this before, when we looked at the raspberry jam factory, we actually looked at an alternative way of thinking about opportunity cost of labour. Now, in a question, you may not have the information to actually do the calculation in this way, but we might as well do it here just to have a look, just to prove that it works. And sometimes it's a nice logical way of thinking it through. So because we're not selling, remember we said that we were going to have 3 units of X that we're not going to be able to sell. We're actually going to lose the revenue from 3 units of X. Now, the selling price is actually $75 a unit. So we're going to lose 3 times 75, which is $225. However, because we're not actually going to be producing and selling those units, we are going to save the materials costs. And the materials costs here are $20 a unit. So 3 units of 20 means that we're going to save a total of $60. That comes back to $165, which is the same total as we had using the other method. Let's look next at the relevant cost of machinery. The relevant cost of machinery varies from situation to situation, and often you'll be given perhaps 2 different options and you need to pick the lowest if you're given 2 different options to cost out. So it could be some repair costs that are going to arise purely because you've used it in a particular project. It could be some hire charges from actually hiring some machinery that you don't own. Or, and this is quite common in questions, a fall in resale value arising from the use of that particular piece of machinery. And this is demonstrated in lecture example 4. Let's look at the scenario. JPLC was intending to sell one of its production machines for $10,000 as it no longer has any use for it. The machine is being depreciated at $2,000 per annum, and the running costs for the machine are $500 per annum. The company's been approached by a new customer asked to manufacture 1 million components for a one-off order. These components can only be manufactured on this machine, and production will take place over the coming year. It's been estimated that the machine could be sold for $6,000 in 1 year's time. We've got to calculate the relevant cost of using the machine to produce the components. Perhaps first we should think about what cost is not relevant there, and in the first paragraph you may have picked up the depreciation of $2,000 a year. Now that's not relevant. We know that depreciation is not a cash flow, so inevitably it's something that may crop up in a part of a relevant cost in question where you're asked to deal with the relevant cost of machinery. So just be mindful to never pick that up as the relevant cost. However, we have got some running costs, and the running costs only actually are incurred when you actually run a machine. So the running costs are going to be a relevant cost, and they're $500. And then finally, we can actually look at the resale value. Now, at the moment, they're intending to sell this machine for $10,000, but clearly if they use it, it's not going to be worth as much in a year's time, and we're told that the actual resale value will indeed have fallen to $6,000 in 1 year. So the other part of the relevant cost is the fall in resale value, and that is the difference between 10 and 6, which is $4,000. So the total cost is going to be $4,500, and that's the relevant cost of using this machine. Section 5, information for reporting and decision making. Information for decision making is very different from information that we use for profit reporting in our income statements and inventory valuation in our statement of financial position. As we've seen previously, absorption costing is used for inventory valuation purposes and for profit reporting. As such, we actually include fixed overheads, which we've already said are not relevant in the cost of our inventory, and therefore we can't use it for decision making. Lecture example 5 gets us thinking a little bit about absorption costing and relevant costing, and gives us some statements to consider. This style of question is going to be quite typical under the new syllabus, where we've got to think about which of the statements in this case are going to be true. So pause the presentation, have a read through the 3 statements, and just think whether you think they ring true or not, and then we'll go through them in detail. Okay, let's look at the first one. The allocation of overhead is an arbitrary apportionment, and so may not reflect the actual cost of making or not making a product. Remember that one of the reasons that we actually do overhead apportionment is to get to the cost of making a product, but if you think back to the stages that are involved, we've actually got a number of stages where we make estimates. So we do some apportionment along the way of costs that we can't directly put into a cost centre. So for example, we might use things like area. We've used things like employees, if we're thinking about, for example, canteen costs, or we might use things like the net book value of equipment to actually share out costs over cost centres. Once we've done that, and once we've indeed done some reapportionment in some cases of service centres to production cost centres, what we then do is we actually absorb those overheads using an overhead absorption rate. Now, the overhead absorption rate might be just purely an overhead absorption rate based on units, or it might be based on labour hours, or we've also seen machine hours for more machine intensive based operations. Now, not all overhead is going to be caused by labour hours and machine hours, so sometimes we might become more sophisticated and move to an activity-based costing system which looks at cost drivers in a lot more detail. Now, that's going to give us a more accurate reflection of cost, but even with activity-based costing, we're still going to have some arbitrary apportionment because not everything is going to fit nicely into cost pools. So the first statement here is definitely true. The second statement is also true. Fixed overheads do not change in the short term and therefore should not be considered when decision making. If we think about some fixed overheads, things like rents, things like rates, maybe salaries of management or supervisors, depreciation of equipment that we use either in the factory or in the offices, then those are things that we actually commit to for a fairly long period of time. So any decision making that we do regarding whether to accept or reject a contract, or whether to make or buy a particular component, for example, then we can't actually affect those different costs in the short term. So it's absolutely right that we shouldn't be considering those when we're actually making our short-term decisions. However, in the long term, these things are able to be affected. So, for example, we might decide to cut salary costs by actually making some redundancies, or we might decide not to rent a warehouse or indeed to rent another one. So fixed overheads don't change in the short term in general, but in the long term they do. So for short-term decision making, we're always going to ignore those fixed overheads in the short term. The third statement here is also true. Absorption costing does recognise that selling prices must cover all costs if a business is to continue to be profitable. If you think about our cost card, then our cost card under absorption costing includes an element of production overhead in production cost. When we've actually added in other overheads, things like admin, selling and distribution, then we come to a final selling price after adding a markup to it. So the very fact that we've actually included overheads within our estimation of what our selling prices need to be means that they must recognise that selling prices have got to cover those fixed overheads in order to make a profit. However, we've seen before that sometimes we get over and under absorption of overheads. So at the start of the year, we actually estimate what the overhead absorption rate should be based on what we think the overall overhead cost is going to be, and also the estimated level of activity, whether that be labour hours or units. So our actual recovery of overhead costs is only actually going to be a full recovery if we actually hit that estimated level of activity, and if the estimated overhead does actually turn out to be somewhere in the region of what the actual overhead is. So if we just look at the options that we've been given, the actual answer to this question is going to be answer D. All of them are true. The final section, section 6, it looks at relevant costing in relation to accounting concepts. Accounts, as we know, are prepared in accordance with two fundamental concepts, and these concepts are the accruals concept and also going concern. So we're going to have a think about whether or not they are consistent with the information that we use for decision making. The first one, the accruals concept, doesn't really apply to relevant costing at all. As we've seen, we're concerned with future transactions and with cash flows. However, we tend to ignore sunk costs in relevant costing, even though when we're doing financial accounting, we actually take them into account. For example, if we're using things like LIFO and FIFO, in relevant costing, the historic cost, which we'd use in LIFO and FIFO, would actually be a sunk cost. We'd be looking at replacement cost, which we don't use when we're actually looking at trying to cost these for our financial statements. The going concern concept is, however, relevant because we do assume that the entity will continue on into the foreseeable future when we're actually doing our relevant costing. However, we do need to just have a little bit of caution, because if we actually cost everything using relevant cost principles, we'd never actually include any costs like fixed overheads that clearly we do have to make sure that we cover in the long term in order to remain in business. The problem comes when we actually need to make that transition between, for example, pricing using relevant cost and actually increasing our selling prices to include an element of fixed overhead. And that's an area that we'll come back to later on. Finally, the qualitative characteristics of financial information. Financial information must be comparable between years and also between different entities. And it also has to be understandable through relevance and reliability, understandable by different users of the accounts. So the shareholders, other lenders of the accounts, maybe the employees and reporting institutions. Now, if we look at the two characteristics, the relevance here is very much on time focus. So if we look at financial reporting, then users are using financial reports very much to look at past and present events. Relevant costing, however, focuses purely on future events. Another key concept that is very important in financial reporting is that of materiality. So only items that are considered material will be included in the financial accounts, and decisions will only be taken as to whether to include those, for example, by the auditors. However, in relevant costing, all items associated with the decision are considered. All 5 aspects of reliability are said to apply with regards to decision making, and these are all characteristics that need to be demonstrated to show that the financial accounts are reliable.